Uh, Good afternoon, everyone. Once again, I know people are going to trickle in from the other session. We apologize. There was no break in between the two sessions, but that also tells you that we have so much exciting content that we are just trying to make time. So hopefully you enjoyed the last session on the CXO CIO's Tech Showcase, and now we are on to yet another exciting fireside chat. This was conceived by us, by a couple of our board members, and I believe you're going to be very, very excited about the content that we are presenting to you. Now, not to delay this further, let me invite the moderator for this chat, Pallavi Sabu, and Pallavi is already online. I know you can't see her right now on VOVA, but she'll come online in 1 minute. Pallavi is the CEO and founder of Harmonia Holdings Group. You probably heard from her yesterday also when she introduced our opening keynote. But one quick note about Harmonia. Harmonia has been a strong supporter of TiE DC from past 2 years, actually. They have been our platinum sponsor. So from that perspective, I personally wanted to come online and thank Pallavi. And also, I know she has prepared for this fireside chat significantly. I was on calls with her late last night also. So I know you're here for excellent content. So Pallavi, why don't you take over and introduce our guest speaker for this fireside chat? Thank you.
Thank you, Manish. Like Manish said, this is Pallavi. Harmonia, my company, is focused on building the innovative next-gen technologies. Like many of you in the audience, we are also federal contractors. And like many of you, having a successful exit is something I aspire for. When I started Harmonia, I didn't come from money. So we built Harmonia from SBIR grants from the Department of Defense. And that's how we funded the company over the initial years. SBIR grants are easier to get than VC funding. So we never looked outside, neither for bank loans or VC funding or nothing of that sort. However, as I look up and look around companies near me, I realized my path to growth was a little slow. If I had looked at a VC situation, I might have grown Harmonia to this size rather than over 16 years, maybe 6 years. So now I do realize that engaging with the VC is important. They come with know-hows on how to exit a company. They come with connections. They come with a very single-minded focus. So even though you're delivering on your day-to-day deliveries, a VC in the mix will guide you towards a path which leads to exit. So with this realization, I'm very excited to hold today's chat. I have as my guest today, Neeraj Gupta, a seasoned venture capitalist. He's a founder and a technologist as well. He's currently co-founder and general partner at Servin Ventures, a VC firm out of the Silicon Valley. Servin invests in seed stage and early stage funds in the innovative technology space. Neeraj himself sits on several boards helping companies create a successful exit. He, like many of us, started his career by building and running a tech company called Symbol Corporation, which exited, I think, in 2004 and had a phenomenal success then. So with that, Neeraj, welcome. It is a pleasure to host you. You and me go back a long time. I remember when we first met, we were 17 or 18 years old in a prep school for engineering college entrance exams. We happened to both get into the same college, into the same curriculum of electronics engineering. And since our roll numbers were adjacent, we were teamed together for 4 years, along with a third musketeer, Pankaj Gupta. Shout out to Pankaj sitting in India. We did all our labs and vivas together. And I might be wrong, but I don't remember the three of us to be studious. How we passed and got out of engineering school is a miracle, especially given the utter disdain Professor Rihani had for us. But we did pass. We both came to the US to different coasts. And through our journey of life, we have kept in touch. So it's nostalgic and exciting to have you here. I have dearly valued your advice over the years, and I hope today you will share some of that with the audience. With that, let me hand it over to you to properly introduce yourself and Servin, and then tell us initially, to start off, the overall state of the VC market. Neeraj, on to you.
Great, Pallavi. That was very well uh, setup. So I really appreciate that. Listen, it's a pleasure to be here. I understand there's a large group from the DC metro area online and perhaps from beyond the Beltway. I'm fortunate to have had the opportunity. The way I see it is, we had the fortune of coming to Silicon Valley at sort of the perfect time, right? So I remember arriving here in the early days when the Netscape browser had just been launched, um, and you were beginning to sort of see the early sort of progression with internet taking hold. And then, of course, we've been through a few cycles since then. So personally, for me, it's been a great journey from engineering school with you, then heading here to the West Coast. Um, so what I do today in my day job is I work for an early stage enterprise tech focused venture fund. So as the tech industry has expanded, of course, the venture industry has expanded quite a bit. I'm sure a lot of the audience here is quite familiar with the VC market in general. But we play in the relatively early stage of the VC ecosystem, and make seed and Series A investments, and that's sort of our general sort of starting point. But we continue to support businesses beyond that. It's across the enterprise tech stack, varying from infrastructure to applications to dev tools, and it's everything that you're seeing in the innovation ecosystem as it relates to how the enterprise tech stack is evolving. So we're sort of closely associated with that, and continuing to work on identifying entrepreneurs when the world doesn't quite when the world hasn't quite discovered them yet. So it's a bit of a complex sort of process because you don't have a lot of data. We are generally investing at the pre-revenue, many times pre-revenue, but most times pre-product market fit. So at this point, it's not necessarily very clear how the companies will perform. But that's the fun of it. It's the fun of sort of working with entrepreneurs at the sort of inception stage of their journeys, and been it's a fortunate time for people who are in the digital sort of transformation part of the industry.
Thank you, Neeraj, for that. My chat box is on fire, but before I go there, help us understand the economics of VC deals. Take, for example, Snowflakes, which had an exceptional exit. What was the economics of a great deal like Snowflake?
Well, okay, let me start with this. One of my best friends led their Series B, and I don't know exactly the exact partnership economics, but I'll give you a partnership economic view of this first, and then we can talk about sort of perhaps how it evolved. But think of this company, right? So if you had invested at Series B, and this is all public data available on PitchBook and Crunchbase, you would have gotten their stock at 97 cents, right? So I haven't checked it in the last few days, but it's hovering somewhere in the 250 range. So that's a 250x, 250 times or greater return on the money that you put in. So here you are as a venture firm. Generally, at a Series A, you would invest what, 10 million. So that 10 million is, you know, um, is 10 million shares, and that's 2.5 billion. And then along the way, hopefully, you continue to maintain your pro rata share to a certain level, and perhaps didn't get diluted as much. And so if you maintain that, then perhaps you did equally as much in follow-on rounds. So you're sitting here at $4 or $5 billion. General economics of a VC firm are, the way it works is generally you'd raise capital from investors, endowments, and pension funds, and so on. And that capital then gets invested in a set of companies, create a diversified portfolio. And in that, after you return the capital back to the investors, generally there's a carry pool of what, say, 20 to 30%. And so if you've returned, let's say, $5 billion as a fund for Snowflake, you're sitting at $1.5 billion of that for a small partnership of a few people. So that's and that's, we're talking about one company in a portfolio. Now, obviously, Snowflake it's an outstanding success. It's one of the return like that doesn't happen often, right? So this is clearly one of the most marquee plays. Generally speaking, it's the power law curve that works in venture capital, right? So behind, on the one extreme, you'll have Snowflake. On the other extreme, you'll have lots of companies that don't return the money, right? So it's a power law curve that is exponential in nature. And so the ones that when you hit, and you hit big, right? So in terms of sort of the economics from founders' perspective, it's generally speaking, you go raise whatever. I mean, in the case of a traditional company, you'd either raise a seed round followed by an A and B and so on, right? So, and depends upon the quality of the deal and the quality of sort of where you are, and that defines your valuation. Valuations have been trending up, right? Seed stage valuations hovering at whatever 6-7 million on average on a sort of median level. And the valuations have expanded a fair bit over the years, and so for founders, it's important to really think about early stage capital, because in a manner that there are two specific aspects to kind of focus on. One is who the partner is. Clearly, you want an average venture deal, and your partnership lasts longer than an American marriage, right? So you want to make sure you're partnering with the right folks around, sitting on your boards, and the folks that you want to really work with, right? So there's that goes beyond mechanics like valuation. The other end of it is valuation, where entrepreneurs obviously have to be sensitive to how much of the company you give away at each stage. And the greater the risk and the earlier the stage is, obviously you're giving away more. And from investors' perspective, we don't necessarily want. I don't think of great deals as we got a great financing deal and we got a lower valuation. I don't think that ultimately actually works, right? So you want to have a fair deal, which is set up in the right, sort of looks at the risk factors, et cetera. But ultimately, a great deal is one that is going to create a lot of money for everybody. So what you're really focused on is less the valuation metrics, and what you look at more the market opportunity. You look at what is the potential of what this company can be. Is this likely to be perhaps a tool that gets acquired by a larger product company? Or is it a product that's likely to kind of have a place for itself as an independent company? Or is it a platform company that perhaps over time can really be a meaningful sort of, a meaningful growth story? So that's sort of what you're looking for. So I don't know if I've answered your question, but yeah. So I'm quite jealous of my friend at Redpoint, who just had this mega exit at Snowflake.
Yeah, your response was very helpful, and it triggered three short questions and short answers. But the first thing, a lot of people feel, including me, dealing with a VC, letting him in the house is like letting a hawk in. Quick 1 minute answer on that.
Yeah, I mean, listen, I think VCs come in different. There's different kinds of VCs, right? I think what is important is to really recognize first, before you even think about VCs as sort of a general category, is what business are you in? What are the economics of that business? And does it even make sense for you to raise venture capital, right? So venture is a different asset class than private equity, which is different than sort of debt deals, which is different than sort of what you might do with your banks. So I think the way to think about VC in a classical sense, is that VCs are not afraid of losing their money, right? They actually expect to lose a lot of their money across lots of companies. But on the flip side of it, they don't want to invest in companies that don't have the opportunity to return a very large outcome, have a very large outcome. So the industry is sort of really set up to over-index itself on high risk and super high reward, right? So if you go to a VC and say, listen, I've got $5 million in revenues and I'm growing 20% year over year, but my market size is, I can get to a $50 million revenue company, but I don't know if it can be greater than that. It's not a VC deal, right? VCs, so a lot of times entrepreneurs think that, I've got revenues, I've got something real, I can get to 50 million in revenues, and this is a good growth story from 5 to 50, perhaps lots of VCs should be interested. The fact is, if it's a 20% growth story that can only get to 50 million, doesn't have a play to be a very large company, it's not a VC asset class company, right? So I think what is perhaps missing, or perhaps there's a lot of sort of, many times I'll see entrepreneurs and I ask them the question, is this really a VC deal, right? So I think one has to think about that. The other piece is you have to think about the stage at which where you are and what VCs make the most sense, right? So if you go to perhaps the likes of some of the larger funds that do sort of later stage Series B and beyond, and you go to them at a seed stage, they might do it if they have had experience working with you in the past, or if you have a very, very specific sort of angle to the way you're thinking about, right? So they might take that seed risk, but that's not their general business. They generally wait for, so if you're a Series B and beyond investor or a late stage investor, you want certain traction, you want certain revenue, you want certain metrics, you want KPIs, whereas the seed stage investor is looking for something totally different. Seed stage investors looking for vision, they're looking for, is this a team that's thinking beyond, is this, right? They're more over-indexing on the team. Whereas later stages, it's a combination of team and metrics and other factors. So to that extent, finding their stage appropriate VCs is important. And within all of this, I generally tell folks that your best VCs are the people that understand your space. And if you go to, if you're just going and doing a sort of general take to sort of think about VCs as, any investor who'll give me capital, that strategy generally doesn't work. So I think it's better to sort of say, I'm in the health tech business. Who are the investors in health tech? Or I'm in the data infrastructure space, right? Who are the top people who are investing in data infrastructure, right? And you can quite quickly figure that out by looking at the top 20 companies in that space and going to Crunchbase and seeing who are the investors behind those 20 companies.
So by default, Neeraj, does it mean that most of the company in the audience today are not product companies, right? They are service providers in cutting edge technologies for the federal government mostly. Are you saying by that there is no scope for a federal contractor? Let's take Harmonia, right? We provide technologies to DARPA. There's a lot of cutting edge technology we built, but it's technology to be implemented as a service. And you could take the entire federal market and the entire banking industry with our technology. Is there a scope for VC interest there or is there not because it's not a product per se?
It's a great question. And by the way, one of my early companies that you briefly alluded to was an IT services. It was a consultancy, right? So I'm quite familiar with the IT services model. In my case, also I had to bootstrap the company from basically a few $100,000 of private capital. And sort of build it brick by brick and sort of write your 16-year story. Sort of, I can sort of relate to that. I think that the way to think about this is VCs are looking for non-linear growth businesses, right? So if you go to them and say, listen, I've got a linear growth plan, and the number of employees or the number of resources in the company is directly proportional to the output of the company, right? So as in a professional services organization, if there is not a huge leverage in some kind of IP leverage or something else, then you end up in a situation where your revenues are very directly proportionate to the number of employees in the company. So if you're an Infosys, you're an Accenture, you're a boutique digital consultancy, if you're any of those businesses, your business model is set up based on those metrics, right? And in those kinds of things, your market metrics are pretty well defined. Market metrics say, okay, you're going to be valued at, let's say, certain times EBITDA or 1 to 3x of your revenues, depending on your growth rate and margin profile, right? So it's pretty well defined. Whereas if you look at sort of the SaaS metrics, right, enterprise sort of SaaS metrics, they're probably, today in the public markets, probably hovering at about 10x, right? And you go to the infrastructure space, like data infrastructure, right? It's the average is sitting at about 13x, right? And those businesses, so just to kind of think about that in sort of that context, you say, all right, well, that's one view of the world. There is another view, which is sort of the extended view, where you think about companies like Palantir, which, I would sort of think about Palantir. It's gone public, so all of the data is available online. So you could look at their S1, look at their investor profile. I mean, their investor decks. They're, it's, to me, it's the combination of IP plus services, right? So they go in and they sell to whatever, national security agencies and state governments, and national governments. But their basic play is that, listen, we've built the best data models. We've got data science. We've got a bunch of IP that we've built. We can leverage that IP in kind of creating models for your specific situation. But a lot of the work that they do end up doing is perhaps, and I haven't exactly looked at it, but gross margins that are higher than a traditional consultancy, but much lower than a software company. So they're sort of in between. So there's an IP leverage, but it's still a consulting business. But they've been able to take it public. There's and there's perhaps the fact that they have sort of deep domain capability along with IP leverage. They've taken it public, and they would consider themselves more a software company and less a services company. I see them as a combination of the two. So yeah, I guess so now, if VC is not the right asset class to invest, I guess there is a huge asset class in private equity that loves the businesses that you're talking about, right? So now they may not do early stage investing, right? So private equity generally doesn't invest in, at least I don't know of very many private equity firms that invest with less than $10 million in revenues, right? But as you get to 20, 30, 50 million in revenues, across 100 million, at that point private equity gets very, very interested, right? And they like the idea of cash flow businesses that are generating reasonable cash. And so I would encourage people to listen. These boutique bankers provide sort of they're in the business to hunt for deals, and right, and they have a lot of data. So I would just make relationships with two or three of those five folks. And at all times, you should, as CEOs of sort of tech services companies, have a couple, three people that you can talk to and say, listen, what are the market comparables? What is happening? They'll just give you so much data. And I get this data because I talk to these folks. They'll just send me reports all the time and say, listen, here's the deal that happened. Tin Roof was bought by Cognizant. Oh, by the way, this was a 3.5x deal. We hadn't seen one, right? Here's the reasons why, right? So you hear these kinds of things that actually help you think about your own business as to how does the market, think about it. The question then becomes, in private equity, is a lot of times if you're a majority shareholder of a company that you run for 16 years, right? At that point, the question becomes, I am now bringing somebody into the house, right? Do I feel comfortable? A lot of this becomes then a question of comfort, and but to scale business, you need capital and partners around you, and there's private equity firms that can truly help. But they can also be, they come with a financial engineering sort of mindset at times, and they could also sort of, now you have a boss in some ways, right? You have a board that you're answerable to. So a lot of this becomes really more a question of your own comfort.
You're so right, because a lot of it is it's your baby, right? And letting somebody else raise your baby, and they might have a way which might be correct and better, but you're so personally invested. So it becomes hard. And you brought up a good point. I learned so much from talking to peers and other people, which you can't just read up on the internet. Talking to people really polishes out or matures your thought process. But with that, let me move on to the chat, which is on fire. There's a company called Korsha, who is a cybersecurity firm which has a product and is providing it to the US government. And the question, Korsha, is how do we approach the Bay Area VCs to raise capital? Cybersecurity is an innovative technology. How are VCs looking at that?
Yeah, listen, cybersecurity is on, there's lots of investment going in cybersecurity without knowing the exact mechanics of the business. And I'm not a cybersecurity, expert myself, but we as a firm look at it. I'm happy to, to talk and sort of provide general advice, and if it meets, if there's mutual sort of fit, happy to also see it through the lens of Summit Ventures. But leaving that aside, I think in general, again, going back to what is the company's sort of, core mission, vision. What I would say is that if it is primarily a play around government, then your first cut of VCs has to be people who understand GovTech, right? So because what happens traditionally speaking is a lot of us who are in the commercial, non-government, commercial enterprise type businesses, we just think about, without knowing how the mechanics of government actually work in terms of the way business gets transacted, we just have this view that it's complex and it's long sales cycles. You're dependent upon a few decision points with few agencies, which may not be true. And I'm just sort of giving you a layman's view from the outside, without knowing how the government areas work. And so the general view is, unless it is, for a lot of VCs, is if government is one of the verticals, that's fine. They would rather have horizontal platforms that go across, right? So does the technology only work for government, or does that also work for banking? Does that work for healthcare or other areas, right? If the answer to that is yes, then I think it becomes, you just suddenly opened up a larger group of VCs to go to. So if it's only government, then you probably want to go to GovTech VCs. Otherwise, you could go to cybersecurity horizontal VCs. Then the question of standard mechanics, right? What does the company do? What's the market potential, competitive landscape, market landscape? Where do you sit in the market structure? Forget about the details of you've got a better product. So if you leave that aside, which is where most entrepreneurs end up spending a lot of time and energy, which is super important, don't get me wrong, until you have a product that's differentiated, it won't work. But let's leave the product-based differentiation aside. I would focus a lot of energy on market and competitive landscape, because a lot of stuff that really comes to us is people have a lot of great tools, people have great sort of small, early sort of ideas. The question we ask ourselves is, can you actually build a sustainable company? Or is this a little small acquisition by Palo Alto Networks? Or is it, right? So, or why would one of these other larger players not do it? And by the way, are they already doing it? And as you know, customers tend to kind of prefer over time, right? Unless it's in specific niche innovation areas, over periods of time, the larger suites kind of begin to take over, right? So do I want to buy, a niche solution for every little thing, or will I just go to Palo Alto Networks, who's telling me that this feature is coming in the next version of their software? So that's perhaps, and to me, the answer to that is not that they don't have it, but we have it, and it'll take them 2 years to get there. I don't think that's a good enough answer. I think the answer lies in, what is the market structure? Do you have a structural advantage? For example, right, in the data infrastructure space, I would argue that you could have the best, call it, Azure can have a better sort of data management solution around Azure. AWS could have one of theirs. But frankly speaking, at the end of the day, my visualization applications or BI applications, et cetera, are going to be, I'm going to use Tableau, I'm going to use Qlik, I'm going to use multiple different tools. So when it comes to that transformation layer, and that comes to sort of data governance layer, or comes to data, so there's a certain sets of things that have to basically sit outside of a single data infrastructure provider. So structurally, the market is sort of saying, listen, I need unification strategies for data infrastructure, even if I'm going to invest in AWS and Azure and a bunch of other kind of underlying tools, GCP, et cetera. But there are certain things that I need to be able to unify. So structurally, now we're looking at, from our perspective, we're saying, market structure wise, there's a need for data integration. There's a need for ELT, ETL companies, right, et cetera, et cetera. So if you could sort of prove that and say, listen, we are playing in this space of cybersecurity. We think, this requires something that's sort of the market structure level. We have a sustainable advantage. I think that'll work.
That was a wonderful answer, Neeraj. My chat is on fire, but our time is up. Thank you so much for being here. If you get a chance and if you have time, right, do visit the chat and see if you can answer any questions, because I see so many questions which I would like to hear the answer to as well. Yeah. With that, Manish, can I hand it over to you?
Sure. Thank you very much. Thank you very much, Pallavi, and thank you, Neeraj, so much for that exciting talk. I was following along, and myself, I also have a GovCon company just like Pallavi. So all the questions she asked were very relevant. So thank you again for taking the time to being with us today, Neeraj. Usually, if this would have been a live event, we would have given you a small token souvenir for your participation, but given the situation we are in with COVID, we are doing everything virtual. So what we are doing is, in the name of every panelist and speaker, we will be donating to a charity of our choice. We have a couple of charities that we work with. We will be donating small amounts of money to them. So thank you again for your participation today. And thank you, Pallavi, for moderating the Fireside.
Thank you both. It was a lot of fun. Bye-bye.
Bye.
Thank you.
Jennifer, thank you very much, Neeraj. Jennifer, you can take over.
Just gonna make sure I rename. Can you just put?
We'd like to
one next
say thank you
names
to our
so that I
sponsors.
can,
Bank of America, our gold sponsor.
yeah, so that I can rename.
The racial and economic disparities that have long existed in this country have only been widened by the coronavirus and amplified by the most recent acts of injustice. People around the world are coming together with greater urgency to demand action. At Bank of America, we know we all have a role to play to overcome the very real consequences of systemic racism and inequity. This includes individuals, governments, nonprofits, and the private sector. Racial equality and economic opportunity are deeply connected. That's why Bank of America has committed $1 billion over 4 years to address critical gaps in affordable housing, access to healthcare, employment and job skills, and the resources small businesses need to succeed. We can do more, and we need to do more now to further advance racial equality and economic opportunity for all.
And thank you to our lunch sponsor, Sevitech. Everyone who logs into our Capital GovCon event today will receive a $10 Grubhub e-card at the conclusion of the conference. And thank you to our silver sponsor, Red Cedar Consultancy. And to all of our sponsors at the conference. We thank you.